My name is Frank Teal, and I'll be your host for this discussion of strategies for retirement tax planning. The National Retirement Academy created this presentation. It's a nonprofit organization. The objective is to develop retirement strategies that work. My company, October Effect Limited, has supported the National Retirement Academy and endorsed the recommendations made within this 55-minute discussion. Today we're going to look at four things. We're going to look at the government spending, Social Security, the stock market, and taxes. All four of these are a critical part of your ongoing retirement. At the end of this presentation, you're entitled to a complimentary retirement planning session. This is a 1-hour meeting, whether it's done on a Zoom meeting or in my office, and my office is in Virginia Beach, Virginia, the town center area. And we will look at your financial situation. In most cases, 3 out of 7 appointments, we will complete the planning process within that hour. If more work is needed, we will discuss the cost and the details at that point. Remember, October Effect is functioning as a fiduciary, so we are always looking towards accomplishing the best activities to better promote your retirement plan. Education is a key part of everything we do. It's been a part of my life since the beginning. As you can see, I started in Iowa as a farm boy, spent 8 years in the Navy, got my undergraduate degree from Old Dominion while I was on active duty, completed a certified financial planner designation in '82, became an enrolled agent before the IRS in '83, my first master's degree in '91, a second master's degree in 2006, and in 2004 I became a certified tax planner. Yes, there's lots of disclosure. The information we're providing is, at best, a few years old and is always tainted. You need to look with your own professional to get the details of what is best and what isn't. There are no guarantees out of what we're doing. There are no absolute promises other than we will function as a fiduciary and with our knowledge work towards your best interest. Don't do anything before you touch base and meet with your navigator, your consultant, and know where you want to go. There is not a sales pitch in here other than my talking about the planning we do and asking that if you like it, come to that 1-hour free presentation. There will be some sales jargon. We can't explain everything without using some of the terms that are involved, but we will try to explain it clearly and keep it simple. Each of you have a dream for retirement. Look in your mind's eye and figure out what that dream looks like. These 5 questions have to be answered to make that dream possible. You need to know your risk tolerance, what you can sleep with, your risk capacity, what the assets you have will provide for you, your portfolio risk. Are there unknown risks within the investments you currently own? Protecting your assets. This is a key component of ongoing financial planning. And finally, finding a trusted navigator, finding an advisor that you can work with on an ongoing basis. Yes, I am applying for that job. What is the government doing to make our lives difficult? Well, they spend more money than they take in, and they don't always spend it for the right things. Social Security disability, $1.1 billion, brought in 952. Social Security itself, in 21, they spent $2 trillion and brought in $1.3 trillion. They're spending more money than they have. Every day we have another 10,000 baby boomers. Here's what government can do to change what they're all about. They could claim bankruptcy, they could cut spending, they could increase taxes, They could cut spending and increase taxes. We know they don't do any of those. They simply print more money. What does printing more money lead to? Hyperinflation. This is a Zimbabwe bill for $100 trillion at the time it was printed, 2021. It was worth 40 cents. That is not the first hyperinflation the world has seen. After World War I, Germany fell into hyperinflation, and that laid the groundwork for the rise of Hitler. How insidious is inflation? Well, a simple 2.7% inflation rate changes $100 to $159 in 20 years. At 5%, it becomes $271 in the same 20 years. So inflation is a disaster. Government keeps inflation. Will government have to do to keep inflation from increasing? Will they have to spend less money, raise more taxes, interest rates, recessions? All of these are possibilities. Unanticipated events that you will incur during your retirement. There will be inflation. You will live longer than you think. Health care will be a major part of your life, and there will be additional expenses. These are the 5 things I promise you will get to do. You'll get to do a tax return every year. Regardless of what you do, the stock market will continue going up and down. If there is bad luck, it may be caused by your cell phone use while you're driving your car. There are other ways to create personal disasters as well. Each of us will incur long-term care needs, whether we're in a nursing home or at home. Eventually, we will need help, and none of us will avoid the ultimate destination. What about Social Security? Well, as you're looking to retire, the years from your age 50 to 65 is when you put aside the most money for retirement. Hopefully the house is paid off, the kids are out of school, you've bought most of the things you need, and you can actually save money. From 65 to 75, you're trying to decide, should I be retired or not? Should I make that step? 75 to 85, you want to be retired because those are your travel years. The key to travel is simple: walking. When was the last time you were at the airport? You had to walk from the parking area to the loading ramps, probably a mile. If that was an easy walk, you're ready for traveling as a retiree. If that was a burdensome walk, you've already gotten past age 85 and you're now looking to live and need help living. Social Security. Yes, you can retire at 62. You get half your benefit, and you have a limit on how much money you can earn, roughly $28,000 a year. If you wait till 67, you get your full benefit, and you can earn as much as you want in addition. If you wait till 70, you get a bonus, you get a larger benefit. The challenge becomes, if I start early, how long do I have to wait before I equal what I'm going to get if I wait till 70? Usually takes somewhere between 82 and 85 to equal out the cash flows. Social Security questions. Husband and wife, one gets a big check, one gets a small check. One of them die. Which check do you keep? You're correct. You keep the large one. Regardless of who dies, the larger check will be retained by the surviving spouse. You get $1,000 from Social Security or $1,000 out of your IRA account. Which one's more valuable? Which one puts more dollars in your hand? You're right, it's Social Security. 15% of the Social Security benefit may not be taxed. This is an interesting discussion. There's an ongoing argument that Trump is saying we're going to make Social Security non-taxable. The reality is, in today's world, if you're earning less than $30,000, in all likelihood your Social Security is taxable. If you're earning $100,000, your Social Security should be taxed and is being taxed. So he's going down a road that isn't productive for any of us. Let's talk about the stock market. Stocks are where you own the companies that build things, that sell things, that are a part of your life every day. Bonds, that's similar to buying a CD at a bank. You give the bank your money. At a given date in the future, they're going to give you back your money. Of the two, which is more complicated? Well, you think the stock market, because we hear about it all the time. Truth be known, it's the bond market. The bond market has this interesting relationship. When interest rates go down, stock prices, bond values go up. When interest rates go up, bond values go down. Interest rates are at a historic low right now. Bond prices will drop if interest rates go up. Bond funds are not safe. Yes, you can lose your money in a bond fund. You can lose money in a broad market when interest rates go up. Here's a picture of interest rates. Back in 1970s, when oil prices went up, interest rates started going up. I bought my first house in the 80s and I paid a 12% interest rate on that house. I was happy to have it. I thought I was a lucky man. Then interest rates came down and down and down. My wife passed away in 2007. In 2008, interest rates hit what I thought was an all-time low, and I applied to refinance the home. Well, the rate that I was going to get was 3.25%, which was a fabulous interest rate. Interesting thing happened in that process, however. As I was closing out Beverly's affairs, a little hitch arose. And in the process of refinancing, I found out I was dead. The mortgage company came back and said, Costco shows you as being dead in their records. Beverly had a Costco card. When Costco canceled it, they showed the wrong person dying. It took me 18 months of letters and letters and letters between Costco, the credit services, and the Social Security to confirm that Frank was alive and to get my refinancing completed. The stock market is risky. Losses are not equal to gains. If the stock market goes up, and generally we're looking at the S&P 500 here over a 38-year period of time, you're seeing rates going up at 8.4% per year over those 38 years. If you missed the best years, you're only going to earn 4%. If you miss the worst years, the down years, you actually earn 14%. If you miss both the best and the worst years, you earn 9.5%. This is almost an argument for active money management, because the worst scenario is missing the best markets. The best scenario is missing the worst markets. What's interesting is if we look at this chart of the markets, when the market is down, in the down years, as you're accumulating, you're buying more stock. Then it goes up, and when it comes down again, you buy more stock. So when the market fluctuates in a downward direction in your accumulation years, it works to your advantage. This, however, becomes a disaster in your retirement. And let's look at the details of that. It starts right here. If your account goes down 10%, it takes 11% to recover, or probably 11 or 12 months. If it goes down 20%, you need a 25% return to recover, which is 2.5 years. 30%, 43%, 4.3 years. 40%, 6.7 years. 50%, 10 years to recover the lost monies in your retirement account. How do we measure risk? This is a complicated mathematical process. It uses something called standard deviations. It basically is measuring the volatility in the marketplace. You all remember the standard deviation curve from high school, where they graded on the curve and the top 3% got an A, and the group between the top 3 and 68% got a B or a C, and everybody under 67 got a D or an F. That's a simple 3 standard deviation bell curve. If you used a buy and hold philosophy, which is what this graph depicts, you're looking at an average return of 6%. A standard deviation of risk says the market price changes by 13%. So one standard deviation is 13%. So it goes from 6 to minus 6. 2 standard deviations takes you to a minus 20. 3 standard deviation takes you to a minus 36. Remember that other chart. Down 36 takes 6 years to recover. The objective is if we can lower the risk from 13 to 5, difference in the standard deviation. 1 standard deviation, you're still plus. 2 standard deviations, you're down 11, and 3 standard deviations, you're down 17. So changing the risk in your portfolio is really important. Sometimes we are too focused on returns, and we need to pay attention to risk. A little higher return, a little less risk. Current risk, average return 12, risk 11. Risk makes a difference. Remember our chart? If we stay in, we buy and hold, we get 8. If we miss the best, we get 4. If we miss the worst, we get 14. If we miss the best and the worst, we get 9. There's an argument for active management while you're accumulating. What are the drawbacks? Here is where the rubber meets the road. Markets are rewarding those who are patient and have the correct strategy for their point in life. Right now, you are in the transition phase. You are moving from the accumulation period when the stock market worked for you to the distribution period when the stock market works against you. What do we mean? Let's look at this accumulation period. We have a buy and hold portfolio for 26 years. 60% in stocks, 40% in bonds. We get this kind of chart movement. Now let's look at the sequence of these returns. On the left side, you have $500,000 invested, accumulating money. If you have a minus 28% return over 20 years, and it happens in the right order, meaning a lot at the beginning of positive and a lot at minus at the end, you end up with $2.5 million. The same returns, only at different times. This time it's a plus 33%, and you still get $2.5 million. On the right, we have one change. We start taking out $25,000 a year. You're retired. You need money to live on. In the minus 28% scenario, taking out $25,000 a year, your $500,000 becomes $1.5 million. In the B scenario, a plus 33%, taking out $25,000 a year, you end up minus $75,000. How can that happen? In retirement, you're taking money out, taking out as fat $25,000 a year. When you get to this low point in the market, your whole portfolio is down, but you're still taking out $25,000. So up here, $25,000 was maybe 3 or 4% of the portfolio. Down here, it's 20 or 30% of the portfolio. When it comes back, you don't have as much money working for you, and so it is an ongoing disaster that just keeps getting worse. i.e., sequence of return is the secret to being successfully retired or having a miserable retirement. Two examples. Both of them retired, but at different times in the market. 1990, over 10 years, he gets a 25% return. He takes out $30,000 a year out of a $500,000 portfolio. He ends up with $1.2 million. In 2000, he retires. He's going to end up with an 18% average over the years. Taking out $30,000 a year, he ends up with $156,000. Notice, 1 minus year, 1, 2, 3, 4, 5 minus years. Half the years were down. This is the problem with sequencing. The matter of returns during sequencing matter. The order in which returns happen or its risk comes into play. Doesn't matter how much you accumulate in the accumulation years, it's the distribution years that are important. What are we looking for in an investment? Something that never loses gains, something that has a guaranteed income, something that's 100% liquid, something with double-digit returns, something that's tax efficient. This doesn't exist. Here are the three pieces that we're dealing with when we're building a portfolio. Liquidity, protection, and gains. How we put those together determines how things work in your retirement economics. Strategy 1, the one we've been looking at all along, the 60-40 portfolio, the one that most advisors have used. I've used it most of my life. Here is the problem with that portfolio. Monte Carlo simulation shows it ultimately destroying itself. Monte Carlo is an AI version of computer processing that's been used in the investment world for over 50 years. So AI is not new to us. It's just having enough computering power to do it. Now everybody has the computering power to do AI. In this example, he's got $1.1 million. He starts retirement. He needs $70,000 a year. For 13 years, he takes money out. He ends up with $614,000 out of his 60-40 mix. How many down years? 1, 2, 3, 4, 5 down years. Half the years, roughly. If we go to the other strategy, meaning the multi-bucket strategy, that's where we put, let's say, a third of your money in guaranteed investments, a third of your money in 5% return, and a third of your money in aggressive returns. What happens? On the left, we have the aggressive portfolio, the $70,000 taken out $70,000. We only take it out in plus years. On the right is the 40% in safe buckets. We take this out when the stock market isn't doing as well. Notice over here we end up with $526,000. Here we end up with $367,000 for a total of $900,000. Almost twice the amount of money that we have in the 80-40 portfolio. And all we have to do is divide it into 3 buckets. Nothing unusual about that. The book. Yes, I have a copy of it right here. The objective of this book, the little book that beat the market, is to tell each of you, you have the ability to manage your portfolio and be successful at it and probably outperform the S&P 500. What Joel Greenblatt has identified is that if he takes the entire accounting world of 35 to 40 different financial ratios and accounting measurement tools, which is way too much for any one person to actually have their arms around, and if you do an undergraduate degree in accounting, it now takes 5 years to even start to know what they are. Joel says you only need 2. You only need 2 of those ratios to find companies that will make you money and allow you to outperform the S&P 500. And what are those two factors? One, that you can look for companies that make money. Two, you can reinvest the money in similar businesses to what you're making money at now, so you can continue to grow the business and have a larger portfolio to work with. Joel even takes this a step farther. Joel has a website, and I'm not able to get to it at the moment. And in that website, he will let you actually put your name and address in. Here's the website. And he will give you either 30 companies or 50 companies that meet that objective. Profitable and growing the company. I use Joel's website once a quarter. If you check it every other day, you will find it is an actively managed portfolio, meaning the makeup of the companies in that list are changing all the time. You will also find there are 10 or 20 companies that tend to be there all the time. The reality is you don't need to own all 50 of them. If you own 8 or 9 really good companies, you will have a well-diversified portfolio and you can outperform the S&P 500. That is not a guarantee. Recap. Look at your risk situation. Understand volatility. Use multiple buckets. Develop a tool plan that'll work for you. Test it. Take advantage of our complimentary presentation. Get together with us, whether it's a Zoom meeting or in person in Town Center, Virginia Beach. We look forward to talking with you. Everybody's retirement plan is a little different, and each of you need hands-on-hands attention. Now let's look at the tax planning side of this picture. Think about what tax brackets you're on and what road you want to be on. Pick a comfortable bracket. You pick that by how well you're educated and how many assets you've accumulated and how much money you make. You draw a strategy, meaning which of the tax buckets am I going to deal with and in what order? What are the tax buckets? Taxable, non-taxable, and tax-free. What does the government do? It prints money. It's not going bankrupt. It's going to reduce your benefits. Well, it doesn't want to, and it's trying not to. And it will likely increase taxes. Those are not givens. We do know that at 73, you have to start taking money out of your retirement account. That is now moving to 75. And as you get older, life becomes more complicated. This is the table that's used to figure out how much your RMD distribution is. If you're 80 years old, you divide the value of your portfolio on January 1 by the number 18.7, and that will give you the amount of the distribution that you need to take out annually. This is an example of what happens with the single largest tax trap that each of you are now confronted with. Pension income, 27.6. Social Security, 27.6. Gross income, 42,003. The tax on that is 1,490 federal. Obviously, there could be some state tax. If you add an RMD distribution of 22,005, your gross income increases to 75,000. The taxable income goes to 47,000. The tax goes to 57,000. It was $1,490. It's now $5,700 on $22,000 of income. Roughly 1/5 of that entire RMD distribution is going in tax. The reason a larger portion of the Social Security is now being taxed. That is the trap that each of you have to figure out how you're going to deal with, if you're going to deal with it. Figuring out how much of your Social Security is being taxed now and how much will be taxed when you start taking the RMD, and ultimately in these tax planning strategies, if you want to do a Roth conversion, what happens with that Roth conversion and tax? Here are the tax traps to be aware of that each of you are going to have to confront going forward. When you start taking RMDs, what's it going to do to your Social Security and how much of it is going to be taxed? When you started drawing Medicare, you had set up Part A and Part B. Part A is free. You pay for Part B. Part B runs about $180 a month. If your income balloons up, above $114,000, that 180 goes to 238. If it goes above 500,000, it goes to 578 a month. That's a 4 times increase in your medical cost a month. My mother, how I love her. I mean, she, like every mother, she did everything for the 5 of us. My mother, in the retirement home, was telling me Social Security is not going to be there when you need it, and I know as a tax accountant and as an economist, the government's not going to do away with Social Security. And my mother, in all her wisdom, had a plan. I'm in a presentation. Had a plan for my inheritance. She was buying coins over the telephone. She had a closet full of collector coins. We know how valuable those collector coins are. The real coins are great. Collector coins are simply nice trinkets to put on the shelf. The real truth in my mother's discussion was Social Security is not going to disappear, but Part B of Medicare is going to use it all, i.e. the IRMA tax. This is the real animal that's going to eat your Social Security benefits, because the cost of taking care of us is going to continue to go up. How do you get out of harm's way? How do you avoid the tax problem? You need to learn how to deal with these tax brackets, these tax arenas. What are pre-tax investments, the IRA, the 401k, the pension? What are post-tax investments, the brokerage account, the bank account, real estate investments? What are tax-advantaged investments? The Roth, the health savings plan, educational funds, life insurance. How do we put these together to make a good retirement that works on your behalf? This was the tax code prior to Trump's first term, when his tax bill went through and he took us from a 39.6 on $400,000 down to 37% on $690,000, a huge tax savings. This bill, however, is about to change unless they finalize the bill they currently have in committee. What's fascinating, and what is always left out, is in this discussion of retirement planning strategies, one of the most positive one is long-term capital gains. Long-term capital gains get a special tax treatment. You're right. A single person can have $44,000 of long-term capital gains and not pay taxes on it. Well, you're thinking, well, how do I have investments or how do I find things with that much gain? That's hard to come by. However, the current tax law, thanks to President Trump, qualified dividends count as long-term capital gains. So if you have qualified dividends in your investment portfolio, and every one of you can have companies that are paying qualified dividends. If you're married and filing joint, $89,000 is not taxable. You go a step farther, $492,000 at 15%, $553,000 for a married filing joint. Remember, these incomes all change your IRMA tax. So the IRMA tax is always there, and it's always growing, and it's always becoming a bigger problem. The current tax law goes away in January of 26. The law they're passing right now is to replace that law. It's not passed, but it should be passed. The single most valuable thing that this presentation talks about for tax planning is a Roth conversion. A Roth conversion says I'm taking the 401k to an IRA and I'm taking the IRA to a Roth IRA. Ideal thing to do. What's involved in that process? Well, you're moving the money through the tax return to a Roth. What does that mean, moving it through the tax return? You pay taxes on the money you move. The question is, where do you get the money? Do you take it out of the money that's in the IRA account? Hopefully not. Take it out of cash you have in your bank? Ideal thing to do. Take it out of equity in your house? That's a possibility. However, the taxes will be paid. Once it's in the Roth account, you then do not have to take RMD distributions for the rest of your life. You can take money whenever you want. It's not taxable. And you can give it to your children. However, they only get 10 years to take the money without it being taxable. After 10 years, there's a penalty if they haven't taken the money out. So what are we all about? How do we move things from taxable through tax deferred to tax free? If you're looking at the 1040, here are the tax strategies on the front page of a 1040. Roth conversion absolutely works. It's not the right direction for everybody, but again, take advantage of the complimentary meeting and figure out if a Roth conversion works for you. If you know you want to do it and you know how to sort of work through it, go to our website, October Effect Limited. Remember my company, October Effect? It's like the month, October Effect Limited. You go into the work calculations in the back. There's a calculator to figure out the tax and the savings on a Roth conversion. Go there and do it yourself. There's enough calculators in our website to do your entire financial plan. In fact, when I meet with you and if we need to do calculations such as Social Security benefits, how long will my retirement last, I go to the website and use the calculators that we have stored there for you. Other planning strategies on the front page: life insurance loans, putting money into annuities, municipal bonds, 529 education plans. They are really good for state tax. Qualified business incomes, running a Schedule C. Beneficiary IRAs. Remember, passing your Roth to your children. The next page on the tax return is the Schedule A and B. Here's where you find medical deductions, long-term care deductions, charitable contributions. Interesting consideration, doing a QCD contribution out of your IRA directly. Meaning if you don't need the RMD coming out of your IRA because you have pensions, rental income, other businesses, the IRA distribution can be given directly to a charity and doesn't enter your tax return at all. A great way to take care of the RMD distributions and not increase your tax. What is a 1256 futures fund? Why is that on the page? I know every one of your advisors has talked to you and said you've got to have a 1256 futures fund. What happens is, in the tax code, there are special provisions for futures trading. In futures trading, 60% of the income is long-term capital gains, and it's qualified dividends. So here's a way to get your qualified dividends with your ongoing investments. And they are good ways to be invested. Schedule C. Everybody wants to start their own business. I want to be an Uber driver. I can play music. I have a backyard mechanic. That all sounds good. If you're good at it and actually make money, you want to do it. The key, however, is bookkeeping. This absolutely requires bookkeeping. You have to keep track of the money going in, the money going out. The IRS looks at the bank to determine what goes in and out, and they will make your life complicated should you not follow through on the bookkeeping. Schedule D. This is where you buy and sell stocks and bonds and real estate and cars and all kinds of things. Everything can qualify as a long-term capital gain. One of the big stories is always we need to harvest long-term capital losses. In other words, your stocks go down in value. Sell them so that you can write them off on your tax return. The problem is you only get to write off $3,000 a year should you take care of finding your long-term capital losses. I harvest capital losses every year. I want to take the money out of there so I can put it into something that makes money. What you really want to harvest are long-term capital gains, because at least $44,000 of that is not taxable. That's a lot more than $3,000. You also can do installment sales, which are useful ways to spread the gains out into the future, and carry forwards can come out of that as well. Schedule E, the front side. This is where the rental property is at. This is where you show the rental property. You can have rental property expenses. You can have rental property depreciation. It's a great way to build your wealth. In fact, probably 60% of all the people in the United States that have become substantially wealthy have done it through real estate. That's because you can borrow money. There are two pieces to this that are absolutely must. You got to keep track of the money coming in and the money going out, meaning all your deals have to be positive cash flow before you figure out the depreciation expense. And number two, you have to do bookkeeping of your time. For you to be able to get the losses, you have to be a qualified real estate professional, which means you keep track of your time. Backside of the Schedule E. This is where you find the partnerships, the 1120S. The big item on the 1120S is Social Security tax by owners. You can divide it up and have part of it taxed and part of it not taxed. So you can reduce your Social Security tax easily. You can hire your spouse, you can hire your children, you can have savings accounts, you can have health savings accounts, you can have real estate exchanges. I mean, there are just a host of things you can do on the backside of a Schedule E. The 1120C says separate tax return. This is for the larger company that's making a lot of money. This is a true tax entity. It has lower tax rates. Remember, the individual rate was 37. Here it's a high of 32. Also, you have fringe benefits. You can have medical reimbursement accounts. You can have business reimbursement accounts. You can have defined benefit plans, defined contribution plans, savings plans, a host of retirement plans. You can pay for your long-term care insurance. You can pay for term insurance. You can pay for educational costs. All of it has to be bookkeeping has to be done, and appropriate records have to be maintained. (1041s). This is for the estate. Your mom and dad passed away and the estate was a little more complicated and you couldn't finish it up in 12 months. An estate can be settled in 12 months. A 1041 does not have to be done. or a 1041 can be done on a calendar year, especially if you think it's going to need to be done on an ongoing basis. The problem in 1041s is the tax rates get high after $600. So this is not a tax saving strategy, this is a tax allocation strategy. It's a return that has to be done. Government wants tax on that income even after the person dies. $706 and $709 are the gift tax return and the estate tax return. The gift tax return is simply a bookkeeping tax return designed to keep track of your distributions prior to the estate tax return. Today, 13,000,006 can be passed in one person without an estate tax return. That means 27,002 can be passed by a husband and wife at the time of their death without any federal estate tax. However, there is state tax, and it's different for every state. And once the estate gets beyond, say, $500,000, there are horrendous administrative issues as you try to distribute that money to the appropriate family members. And complicated estate planning does not speed up the distribution process. It can minimize probate, and it can minimize what information has to be shown to the public, but it's not the fastest way of distributing assets. When you meet with my open planning session, or you meet with your advisor, ask about the most efficient way to transfer the money from you to your family within 30 or 60 days. It's not going through a trust. All the strategies from all the different pages. Remember, this is an ongoing project. It doesn't happen overnight. It requires constant work. When I start working with an investment client, we meet 2 or 3 times a year just to stay on top of, one, their investments, and 2, their ongoing financial picture, which includes their balance sheet, because there ultimately will be balance sheet questions. I need a new car. I need to refinance the house. I need a new roof. The child needs a house. The child needs a car. Where's the money going to come from? Those are balance sheet questions. You need a personal balance sheet. Your advisor should be maintaining that balance sheet for you. It lets you make the decisions on where's the best place and the best things to liquidate to generate monies. So now we've covered everything from the government overspending to Social Security options to investment decisions to tax planning. It's your job to figure out what's going to work for you. What do you need? How do you rebuild? How do you build that retirement plan? Risk analysis, current plan, dividend distributions, 401k accounts, what bucket strategies, all of these are pieces that you need to incorporate in the planning process. Take advantage of our complimentary meeting. That 1-hour Zoom meeting or that 1-hour meeting in my office in Virginia Beach, you want to do that. It's free. It lets you get insight into your personal situation. I hope you enjoyed your time. This presentation should be available on my website. Again, October Effect Limited. Go there and repeat anything you need to see again. You can set an appointment with us from the website. I'm looking forward to our next meeting. You make it a good day.